Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Stewart Heath of Harvard Grace Capital. What do they do? Passive real estate investing, and we're talking syndications today, but what we're really talking about is patience, resilience, and the calm to give over the control to somebody else. We also talk micro markets and geography right now. This is episode 362 of Zen and the Art of Real Estate Investing with my guest, Stewart Heath. Stewart is the founder and CEO of Harvard Grace Capital. There, they target, acquire, syndicate, and operate Southern commercial real estate. They operate primarily in the I-64 corridor from Nashville to Birmingham. Stewart, welcome to the show.
Thank you very much. I really appreciate it.
Yeah, I'm excited to talk to you. I know you also have a background as a CPA. What led you first to real estate?
Real estate has really been sort of a passion of mine since I was a kid. It sort of piqued my interest. Just watching my parents, when my grandfather died, my mother got an inheritance, and it was mainly land and stuff like that. And I was like 10 or 11 years old, and I'm like, what do you do with all that land? That sounds boring. And then I just started paying attention to it, and seeing the sheet, just this number of acres and some estimated value. I'm like, oh, you got to be kidding! It's worth real money, and that was timberland, and they needed to wait a few more years to harvest it, and blah blah blah. But anyway, it's just always been back there, and in the back of my mind, in that it's something you can have and hold, and unless you default on a debt, nobody's going to take from you, and it's real. You can touch it, you can walk on it, and that's always just sat well with me. I did go through a phase early in my business career. I came out of college in 1985, and about a year before they passed that dreaded 1986 Tax Reform Act, which devastated a lot of investment in real estate for about 5 years. And I remember bankers and people telling us at various functions that real estate was bad and you shouldn't invest in it. And I guess at that time they preferred collateral that had wheels and could go from state to state.
Yeah.
And I very quick, again, I was a baby business person. I was just sucking in whatever I thought somebody had to share. Then when I started I left Price Waterhouse, started my own CPA practice. I collected a whole bunch of real estate people, from contractors to real estate agents to fixers and flippers. And it just dawned on me one day, during tax season, these people are all, they're all making bank, man. They're making lots of money and not paying any taxes. I was like, perhaps I should relook at this. And so I did, and sort of got into it, and just, it just jives in my head. I just like real estate. I understand it, and it understands me. So
yeah, across the board, CPAs always say the same thing. I was looking at all the taxes, looking at these investors crushing it, and I was helping them use the tax code to their advantage. Yeah. And then I realized I don't have any real estate. But I wanted to go back to something interesting, because you said that a lot of the land was timber at the time. That's really interesting comparing to syndications, because with timber, you own the land, but you have to wait for it to produce. So there's an element of patience to real estate that maybe these, kids now who are growing up watching TikTok don't understand. And that's really what syndications are about as well, right?
That's right. Yeah. Interesting fact about that. Some of that land, my mother and her siblings had helped plant those pine trees when she was a child.
Yeah.
So, they had waited 50 years in some cases to harvest that timber. And anyway, that's a whole business to itself. But yes, syndications are, real estate is a get rich slow plan.
Yeah.
And if you're patient, who was it? Some guy long time ago says, don't wait to buy real estate and wait. I forget who said that, one Rockefeller or somebody like that.
Yeah.
And it really is. If you give it time, it will always win out. And to me, it always just comes back to the basic supply and demand rule. God's not making any more real estate right now.
Yeah.
And if you buy it in the right place, which is rule number one, it's just simply going to increase in value. But like any investment, you have to be prepared and have reserves and be prepared for ups and downs that are almost always temporary. Even the oil slump of the 70s in Texas, real estate was, the housing market was devastated, but it's not anymore. Even that was temporary. So,
yeah, I mean, I think for those of us who've been through market cycles, we know. And we try to relay to other people, like you're saying, just wait, it'll be fine. But I think new culture, because of technology, we didn't have the internet growing up. So I didn't have, 100 videos coming at me all the time telling me what I could do with my money. I just listened to my dad and picked up rent and did what he did. And you saw your family doing it on the slow. I wonder if people can start to adjust to it and understand that really in America, with the opportunity to have even 30-year loans, you can just sit on something if you make a good purchase. But you were saying location is really the most important thing. Is that how you started and still how you focus? Because I know you focus in one geographic area, although it continues along that highway.
I've been doing this really since 2001, and I've made a lot of mistakes along the way. I even wrote a book about my mistakes called "Don't Do What I Did."
Yeah, I love the title.
But really it's where I just boiled down our systematic approach for buying real estate. And rule number one is, rule number one is you make your money on the buy, not the sell. You can't overpay. You sometimes can wait it out and still make money, but you'll never make as much money as you would have if you bought it right, which takes some patience and some discipline.
Yeah.
Rule number two is location. You got to be in a good market, and that is on a micro level. You just can't say, Nashville, Tennessee is a great market. Well, some of it is and some of it's not. You got to get down to the neighborhood, sometimes the street level, and every community's got good and bad spots. And if you're really gutsy, you'll go buy stuff in the bad place and really wait.
Yeah.
Everything's on a cycle. And the bad place will eventually turn around. Places that my parents wouldn't let me go as a kid are just booming and top of the market right now. So
yeah, same. I love talking micro because I do a lot of commentary for newspapers. They'll call and they'll always want a headline for, national real estate news. And every time I say the same thing and they don't publish it, I say, you can't make a headline about national real estate news. It doesn't make any sense. And I just yesterday was saying exactly what you just said. Just within a city, there's a buyer's market and a seller's market. And then if you're talking commercial or large scale, it's a whole different game. You can't just quantify real estate as the country, like it's an up market or a down market. As you're saying, neighborhoods change on a dime in cities also.
They do. As you mentioned in the intro, I focus on the geography from Nashville to Birmingham up and down I-65, and Huntsville is sort of right in the center of that. And Huntsville's going through this great, incredible growth curve and probably will continue for the next 20, 30 years. But it's got everybody who owns the stuff there. It's gotten really hard to find a reasonable deal there because everybody thinks it's made of gold. And I've even had these conversations. Yes, but this is Huntsville. I said, but the interest rates are the same in Huntsville as they are in Birmingham,
Yeah, exactly.
And so, and they're fine to hold it, and they should. Unless you just really want to sell, you should hold. So.
Yeah, I mean, I loved, my dad was a hold investor, like almost to the max, like would never get rid of anything. Then I grew up kind of trading a little bit, but not over trading, but I certainly made some mistakes there. I'm sure you have as well. It's like you trade one and then you're like, oop, that was the one that was the one I should have kept. But as long as I did well, I don't really dwell on it, but I can look back and try to make a better decision next time. What were some of the worst decisions that you made? You said you made mistakes. And of course, the book is like, don't do what I do. What do you think is a big mistake that you made that you'd like to help people prevent from making in today's market?
Well, the single biggest mistake, and most of my mistakes were in the late, what do we call them? The O's, 06, 07, 08. And when credit was easy and everything was going up 10% a year, and I was doing this pretty much by myself, and I was buying this one and then waiting 2 years, refinance that one, pull that cash up. I was doing everything with debt.
Yeah.
And then the merry-go-round stopped, and what Warren Buffett famously said, now we're going to see who was swimming without their trunks on. So, that was me.
Yeah.
I mean, because when you pull debt out of real estate, asset values crash. And that's what happened in 2008, 2009. And those that had cash, were able to swoop in and get some real bargains. So I was not proceeding cautiously with reserves. So here's the thing, that everybody needs to understand, and that I learned the hard way. You don't know what you don't know. I mean, who would have ever thought back then that Countrywide Mortgage would just simply go broke?
Right. Yeah.
And announced 3 days before the end of July 2008 that, or 2009, by the way, we can't fund any of our mortgage commitments at the end of the month. Bear Stearns goes belly up. Lehman Brothers goes belly up. I mean, these are some of the biggest names in the financial world going broke.
Yeah.
I mean, so there's no replacement for just having cash on the side.
Yeah.
Reserve, and you hate not putting it to work, but you don't know what you don't know.
Yeah, that's part of why I turned to syndications only a couple of years ago as an LP, because I realized it's a great way to keep money away from myself, but also to keep it in something with, I don't want to be active anymore. I'm getting older. So if I put it in a syndication with a trusted operator and I can watch it cook a little bit, now I'm still keeping plenty of cash on the side or in index funds, but now I have a couple ways of moving stuff around, and I can see, okay, there it's going to go do something. And I think sometimes people need to take that as a cue. Sometimes you need to protect it from yourself. Like if I keep it, maybe I'll do another flip and I'll make money, but I'll hate every second of it. So why don't I just do something that's a little bit more, is easier for me?
Yeah. You must have been better at that than I did. I did 2 flips and figured out that I made $1 an hour. So
yeah, I learned early in flipping for myself. I just needed a buffer in the middle, hired a project manager. And instead of showing up every day, I started showing up once a week. Then it was once a month. And even though it annoyed me less, and I still did well. So I think I did better the less I was there, because I would fire more people when I was there. Sure. But again, that's another thing that I like about syndications. I can't really drive the bus. I'm just there as a kind of passive bystander. I can read all the information, see how everything's going, ask a couple questions, get the answers, and then learn along the way from experienced operators how to do it in case I want to do that later.
Yeah. Yeah. And that's the thing about real estate. You can do it with others. You can do it by yourself. You can do it completely passively. Yeah. Or you can do it all, you can be as involved as you want to.
Yeah.
Most good sponsors are happy to have input, from their investors. They don't want you to annoy them.
Right.
But I love talking to my investors. And it seems like it's always the sort of what I call the micro investors that are the nervous ninnies, and and usually I just end up buying those guys back out because they're clearly not happy. And they're afraid of what they did. So,
Yeah. And it is hard though, because you're on your end, you're also doing due diligence for the investors coming into the investment, but sometimes they seem very cavalier about it. And then you realize afterwards, ooh, wow, I didn't expect that. So that's a good point though. I never thought of it, because a lot of people think of, oh, you're kind of stuck in the syndication, but you can just get them bought out and say, maybe the money is used a better way, just because it's going to be a headache the whole time.
Yeah. Yeah, I mean, and again, in my experience, it's almost always been the $25,000 and the $50,000 investors, and I'm not poo-pooing that money. But they're the ones who tend to be more nervous. They've probably really stretched to do that, even though they met the definition of an accredited investment. Right. And so it's just more comfortable for everybody. No, I can't sit here and say I could buy out everybody, but the vast majority of our investors are pleased, and they understood the risks. Yeah. We try to boil everything down to where the only risk we have left is vacancy risk, and sometimes there's nothing you can do about that. You just got to wait it out.
Yeah. Yeah, I think there's a lot of user error for limited partners. I think someone tells them about syndications. They think it sounds like a great idea. They don't really listen to when they're going to get their money back, or if they're getting distributions, and they're just kind of putting it in there. Yeah. But then they take a look afterwards, or they want a car or something.
Right. Exactly.
And as you were saying before, reserves are so important, and they didn't leave themselves enough reserves. But I try to be very clear, like, syndications are pretty illiquid. Like, you just assume you're not going to touch the money until it sells. But again, it's hard to find on the way in. Is the goal for you as a syndicator to just kind of keep having the same people come back and then referrals from them? Because I sometimes find it's that newer, outlier who is the one who really didn't get it.
Yeah, for sure. And sometimes the ones that get in because their buddy got in, and I think there's a little bit of a want to be a member of the club kind of a thing.
Yeah.
And I take some responsibility on that myself, because I have conversations with every person, and just to make sure we're all on the same page. And sometimes I'm accused of trying to talk them out of it. Now, I just want you to know, you can't get out of this. Now, all of our deals are cash flowing, so people do get cash flow along the way. Yeah. But it's somewhere between 6 and 12%. Usually grows over time, which is nice. But it's still not calling up your mutual fund and saying, I want to sell and get your money back. We refinance usually in year 3 or 4, and pull cash out and give that back to the investors. So there's some liquidity that comes a long way, but still that's 36, 48 months down the road.
Yeah. Yeah. I've found LPs who didn't realize they weren't going to get any distribution during the time. And I said, well, you invested in a hotel turn. Yeah. What did you think you were going to get money for in the beginning? It's going to take, 18 months for the construction to be complete. And they were like, I didn't think about that. But I know somebody told them about that, or it's at least in the documents. There's no way. So
everybody signs that they read the document.
Exactly. Yeah.
I've got 2 investors out of our 100 or so that I know have read the documents.
Yeah. But I mean, that's the thing. That's why I think there's a lot of because some syndications didn't go so well over the last year, a lot of people put it on the people who were running it and the GPs. And then when I looked into it on a lot of them, and you see what the people signed, it was very clear what they were signing. They just didn't pay attention. Not in all cases. There was obviously some error on those parts, but I found a lot of people passing the blame. And as you were saying, they want to get into the club. It sounds like a good idea at the time. And then, their spouse or partner says, well, we were going to go on vacation. We need that money back. And then they think they can just get it back. But again, if you go back to how we started, if they just would have let it cook in there, they're going to end up with a great job, after the 6 years. If they would have just let it cook, they'll be sorry for it later, most likely.
Yeah, they will. And the thing is, they just weren't prepared to be that kind of an investor.
Yeah.
Sometimes meeting the definition of an accredited investor, which is one government restriction that I think actually makes sense.
Yeah.
But sometimes meeting that definition doesn't mean you're really ready to be an investor.
Yeah, I agree. I think there's a bunch of different mindsets for investing, and what I think of as the accredited investor mindset is one who's willing to ride in the back. It does take a while to get there, though. I mean, I only started investing, passively in syndications, after I was 50. And I realized that part of it was ego before. Like, I liked to drive the bus. I didn't like it, but I liked it. And then when I started to take the time to choose the right operators, I felt much more comfortable sitting back. And then as they produced, I was like, this was a great decision. But I think it is hard for people who've been the forerunner of their active investments for so long to sit back and trust someone else.
Yeah. I've done a few myself with people that I know well, and you just, you have to tell yourself, I'm not driving.
Yeah.
To use your analogies, this is this is just an investment.
Right. And, enjoy the ride.
I tend to be a bit of a control freak myself. So,
but I think that it comes naturally in the business. But I think, if you build the trust and you do your due diligence on the operator, and then you understand, especially from your point of view, because I'm not a GP for anything, you look back at what the dynamic is like between you and them, then you can understand, okay, I really do need to sit in the back. I want them to sit in the back, ask a couple questions.
Right.
Let's talk asset classes. What asset classes are you guys investing in at Harvard Grace?
Officially, we say that we are asset class agnostic. We focus on our geography because we can be close rather than that. We will take a look at almost everything. Things we haven't done because we hadn't found those that work are multifamily and industrial, multi-tenant industrial, because we do cash flow deals.
Yeah.
We call them boring investments. And so there's so much competition on your average multifamily deal that, they're not going to cash flow from day one. So,
right.
And most of that stuff is, the value add guys will outbid us every day. So
right.
I still underwrite them and we still look at them. I think it's probably the best asset class out there, but not for immediate cash flow.
Yeah.
So we end up doing a lot of office, and which sounds crazy to some people in the country, but in the South, we kind of pretended like there was no pandemic from about June of 2020 on. So and everybody still goes to the office. They might not go 5 days a week, but so they're going 2 or 3 and they still got to have an office. So, and I call that suburban office. I'm not real big on downtown offices or some class A. We are under contract on a class A asset right now. And we're going to get it at a 10 cap. My absolute favorite asset class is medical office. And these doctors, they'll put hundreds of thousands of dollars of their own build out, of their own money into their build out. They sign 10-year leases. So, I mean, it's just a very textbook example of stable.
Yeah.
And they're not going remote. They're not going to get replaced by AI. They're not going to come see you. So they got to have an office. So,
that makes a lot of sense.
I just love that asset class. And a lot of them tend to be owned by doctors, which make perfect acquisition targets because they're all mismanaged.
Yeah. They don't have the time.
Well, they don't have the time. They don't have the, they're so brilliant in their own way.
Different skill set.
They don't understand finance. And a lot of times they take really good care of the building, but they don't understand the first thing about leasing. And that's where the values drive. So, they don't raise people's rent. I've actually coached some of them through, if you want to sell for this price, here's your 3-year plan.
Yeah.
And sometimes I've come back and bought that from them at the higher price because, it made good sense, but I couldn't do it before. So, I'm a CPA. I'm always counseling, like, here's how to get where you want to go. So,
Hey, it's Jonathan. I hope you're enjoying this episode with Stewart Heath, and I want to remind you on this brief interlude that we have one of the best guest directories of any podcast out there. I've actually never seen another podcast, even the best ones that you listen to that aren't about real estate. I've never seen a guest directory where you can search like ours and find all the information on every episode. So go to zenandtheartofrealestateinvesting.com. Look for the guest directory, plug in any term, any name, and you'll find it. Let's get back to Stewart. You mentioned something interesting about office that I've thought a lot about and talked about, is that even if people did go remote more, the company's still paying the lease. So as somebody who's syndicating an office, you're fine. So even when people drive by a lot and they say, oh, parking lots more empty. It doesn't matter. Yeah, it doesn't matter. Those are huge companies. They're not getting rid of their lease because people do still come and go. That's their headquarters. They're not closing their headquarters.
That's correct.
Yeah, so that's what I found. Even in states like I'm in New Jersey, Northeast. Office people perceive as in trouble, but it really depends on what's in the office complex, right?
Yeah. One of our rules, going back to our to my book, and the book's free, by the way. I'm not pushing people to buy it, but one of our rules is we underwrite the tenants, like a bank, because that's the genesis behind the income, and we pass on a lot of deals that we don't like the tenant makeup. So we like properties where those tenants meet their customer at the property. So call it service retail, or retail. We like retail as well. But the Class A buildings, with the marble in the bathrooms and stuff like that, that's just where companies sort of used to collect their employees. It's not necessarily where they did business. And so those are the ones that are really struggling. And you kind of alluded to this before. When you're talking about national real estate, office was declared dead nationally. And no, it's a local issue. But just saying office, I mean, there's about 6 different subcategories of office. So what exactly medical office never had any hiccups. And a lot of our properties never had any issues during COVID either, because they're of that suburban style, and that's where people meet their customers. They're State Farm agents and mortgage companies and dentists, and just tenants like that. That's where they do their business. It's where they see their customer.
Yeah, and I still think retail has a very long tail to do even better, because the way that I see it, even with all the advents of AI and more technology, I think people are just hungering to get back to in person. I mean, I have my own real estate brokerage. I have a space on Main Street. I still want to do business face to face. I have to. I don't want to get out of that. And when I do business with other people, especially as it becomes larger scale business, I'd rather have the face to face.
Absolutely.
That's why shopping centers are still doing well, and people declared those dead as well. But
back during COVID, retail and office were both declared dead.
Yeah.
And then and then nobody could develop any retail, especially for the next couple of years. And now what's happened to retail rates? They're shot through the roof because of a simple rule of supply and demand. I think we're going to see that turnaround for most office. Nobody's developing office space. And I think, again, taking some time, I think by 2030, it's one of the reasons we like office now. We can buy it at a 9 or a 10 cap. I think cap rates are going to fall simply because of supply and demand come 2030, 2032, something like that, which would be about the time we want to unload. So that's our theory.
Yeah. And one other thing you mentioned that was important about when you were looking at office, you're looking for judging the tenants. I mean, that's big for shopping centers as too. You're looking for anchor tenants, and you're like, oh, well, Walmart's never going out. So let's build around, and everyone wants to be around that. Similar to, you don't want to be the first tenant in an office complex, because then there's no extra traffic for you there.
That's right.
Yeah.
Right.
Have you guys done self-storage?
Yes, we have some storage. because we do manage everything. It's not my favorite class. Ours is doing just fine.
Yeah.
It's a very retail business and a little bit like babysitting.
Yeah.
But
a lot of like little stuff that means almost nothing. That's what comes up.
Oh yeah, but storages scare me. It has a tendency to get overbuilt in certain zip codes, and you don't want to talk locally. You're talking about a maximum of a 3-mile radius.
Yeah.
And if you get too much competition if you're the first, you usually are okay.
Yeah.
Because people tend to not move, but it gets real hard to replace customers as they turn over. So we are expanding the one that we have, and then we'll probably take that to market. And there's a whole investment community that's all they do.
Yeah.
And they love it. And I'm just like, I'm happy for you to have this. So
yeah, that's important to know though, as a GP. Like, okay, part of it is we're going to turn over the asset, see what we like. Self-storage is great for that, because if you operationalize it and set it up, someone's going to buy it. There's plenty of buyers
will
for
buy it. Yeah.
Are there any other? You said no, not a lot of industrial, right?
We keep doing some, and another one of our principles is it's got to be multi-tenant, and there's more and more multi-tenant industrial.
Yeah,
haven't pulled the trigger on one yet. We're always underwriting some. If we can get it for right place, and again, going back to the tenants, if we like the tenant mix, then we'll pursue that, because I think there's a lot of good strength in that asset class.
Yeah.
But it all does come down to the individual asset. So I think industrial is strong. As I look around our area, everybody was building industrial here a few years ago. There's still a bunch of it that's just never been rented.
Yeah.
So I think there's a bit of a glut of it on the market.
Yeah. It's really interesting to me, though, that you're willing to focus on the asset classes and focused on the geography. I think it's really smart, and I like it because you do have to put a little bit of a different lens on each asset class, like, because you're the way that you evaluate it, but it really ingrains you into a very specific geography that makes it easier to say, well, we don't need to look at any deals from Pittsburgh. Like, this is our buy box. Is that what's helped you over the years?
Yeah, I think so. People, at least our investors, like the fact that we're close.
Yeah.
I'm really no more than an hour and a half from any of our assets, and I've got a remote workforce that somebody's always within a half hour of one of our assets, and to me it was just natural. I go with what I know. I've lived my entire life on I-65, and that'll be my memoir. And I just know the area. I know what's going on, from Mobile to Nashville anyway. So, they say, invest in what you know. Well, that's what we're doing. So.
Yeah, and you can find cooperative assets. I mean, if you're balancing and you understand, okay, I have office here, and then you can evaluate storage with a different lens, but you already know the demographics and you know the area well. Now you can kind of help those assets out and diversify yourself and your investors within, like you said, within a market, which I've had a few people on recently who said, yeah, it's still just a 2-mile radius, even that many years in the game, because a 2-hour. Because it just makes it easier to know your inventory, know what's happening, and then also see what's happening with the cities, because that gives you a heads up on what may play in your favor or against you, especially when you own large scale assets.
Yeah, and we're a bit different in that we only buy stabilized stuff. So we have not, praise be to the developers who take the risks and they do the lease ups and stuff. So I'm just coming in there and basically trying to do a financial transaction and making a margin on between the rent and the interest rate. So to that extent, our investment philosophy is the same no matter what the asset class is.
Yeah, that makes sense.
But somebody's already done the hard work of getting them filled up, and so. But there is still nuances to every different asset class, because the leases are a little bit different, and landlord's responsible for what, and tenants responsible for, industrial is very different than office in that regard. So
yeah, but it's interesting though, because one of your core tenants was you make the money on the buy, but on these, you're kind of paying probably not market value, but close to it because they've operationalized it correctly. But there's a lever that you can push into the future where you're saying, I mean, it's real more going back to what we said. This is true long-term thinking. You're buying something that's already strong, which I advise a lot of small multifamily investors to buy something that's already renovated. You're going to get the highest rent. Now you have a great asset. And the ones who get it go, yeah, great idea. The ones who don't say, oh no, I'd rather do value add. And then you say, good luck. Is that why you didn't get into value add? It's just a long run to play with the asset.
Well, so as I mentioned before, I've done fix and flips. I've done development. I've done a lot of stuff and I've done all those things, been there, done that, and lost the t-shirt, kind of thing. So I'm just trying to de-risk everything. I'm simply trying to make money on the arbitrage between interest rates and cap rates. And we're I think we're coming into a sweet time where that's going to be a little easier for the next 18, 24 months. As interest rates are falling, and it'll be easier to find a price that sellers are willing to sell at. But as I said before, I'm trying to remove all risks except for vacancy risk. So, I still have a vibe in my head that I want to go do some development because, that's creative and fun. And so it's where all the risk is too.
Yeah. Yeah.
I mean, for the guys that are good at the value adds, I mean, God bless you. I mean, you're really good at what you do. But construction delays and, getting the people to show up on time and keeping your costs under control.
Yeah.
Been very challenging the last 3 or 4 years. So.
Yeah. I mean, there's just so much red tape that it just, you never know, something could turn you off for 6 months. And then you have, again, it's hard. And that's a difference. It must be easier to relate to your investors because you're not going to have that type of issue. Oh, it's going to be another 6 months before you see money. 4 out of the 5 syndications I'm invested in they pay every month. It's been great. And then 1 is a value add, but it was intentional. I had watched them do 1 and I'm like, I'm just going to go in on this. I just want to see it. I understand the risk, but I really get what you're saying because if you're just working the arbitrage between that, it really takes the risk and boils it down to almost nothing. I mean, there's always some risk, but it's very unlikely that there's a catastrophic, something that goes wrong because you have an operational asset already. You're just using a delta to make more over the long term.
If you get multiple tenants, the likelihood that you lose all of your tenants at one time is pretty remote.
Yeah.
And so that's when we're going in there, we worry about things like, tenant concentration. You got one big tenant and a bunch of little small ones. We try to avoid that.
Yeah.
But that said, sometimes if you get a 25% tenant, that can hurt.
Yeah.
That might be where all your margin came from. You're still going to cover your, and we've had that happen for a season and we've recovered from those and now have been able to return to cash flow. And some of those we were still able to distribute all throughout, the vacancy. And we had one where the biggest tenant in the building went out almost in the first month after we bought it. And believe me, that's when I think about a lot. How did I miss that? And anyway, but it took us a year, but we recovered it. We've turned over half of that building and with better, higher quality tenants. And we're at a strong cash flow position there. So, but there's always something. We got another one where we're dealing with a tenant. But again, that's the risk you really can't eliminate.
Yeah.
I don't do floating rate debt. So I don't have to worry about, interest rates moving while we're in the property.
Yeah.
So, and we don't do any value adds or stuff like that. So.
Yeah, it is really good risk mitigation. I mean, and it depends on what your investors want, right? If they want to be more flashy, maybe they're going to go for something that's a development. Hopefully they understand, what that's going to take. But there's so many different investments out there. Are there any other commercial investments? Are you guys interested in elder care or anything like that?
Not specifically. We try to stay away from specialties. I have some colleagues and friends that that are in that, and if people are interested, in, we can refer our investors to what we think's good operators. I've been close to some in that, and then they seem to have trouble keeping a hold of their licensed operators. Like so many things, there's shortages of those people in the industry. So I don't like things that are dependent upon one person.
Yeah. No, I mean, that's true. Yeah, but it's just, I keep going back to it. I'm thinking about it as I'm thinking in my head asset classes, and then I'm thinking, no, wait, Stuart's into geography. It's about what comes up in the area. So in your buy box, your geographical buy box, are there any asset classes that you think are going to make a move and be more, obviously multifamily, I think you said before, that's always going to be interesting, but there's so many players in the game. Are there any other asset classes that you see emerging that might be opportunities for you inside your geographic corridor?
Well, I'm convinced that sometime in the next 12 months, we probably will land on an industrial asset that we like, and we'll put a contract on. We're always pursuing medical office buildings.
Yeah.
And I think as general office improves or has decreasing cap rates in the coming years, medical will do the same. Because I don't understand it, because medical office has not really had any real hiccups, but they have been affected by the cap rates associated with general office.
Interesting.
Good for me.
Yeah, right.
Because I want to buy at 8 and sell at 6. So I think we're going to see office make a big move in the next 5 years.
Yeah,
and it will be highly local. We're already at a highly regionalized real estate economy now. I wish that we could get to some highly regionalized interest rates. Location will be key, as it always is. So.
Yeah. So for somebody who wants to get into being an LP, what would you tell them? Now, you've gone through it all. You've invested as an LP. Now you're a GP. I always try to help people understand, for people who are kind of, scared of passive investing and scared of passing the baton to someone else, what advice would you give them on that?
I would say trust your gut. If you're scared, that's a good thing.
Yeah.
Do some research. We put together a resource a few years ago called 100 Questions You Should Ask Your Passive Activity Sponsor. It's free on our website. It's pretty exhaustive. It talks about the deal itself. It's questions about the sponsor and their background. I mean, some of them are very pointed questions.
Yeah.
And because as the passive investor, you don't have a responsibility to run the project. You do have a responsibility to yourself to investigate the sponsor.
Yeah.
And actually, it makes me feel good. I have great pressure. You mentioned it a minute ago. These people who've signed everything, I know they haven't read it.
Yeah.
And suddenly they wire me $250,000 to get, and I'm just like, oh my God, do they know what they're doing? And I've had conversations with them. I feel a lot of that pressure. And so it's one of the reasons we put that resource together, because there are lots of really good questions you should be asking, especially on your first deal. And you need to get to know, like, and trust the sponsor of your investment. And so a lot of people have resources like that. And so ours is not exclusive, but I think it is a good list of questions. It's just a free PDF download that, so ask lots of questions. That's what I would advise. And I'm happy to talk to anybody. I always say that when I go on a podcast, and I occasionally get phone calls, and I will coach people through who are considering not investing with me, but with somebody else. I'm all for it. So
I think just reading through the questions gives you a kind of overview of what you need to look for. And then you can also boil it down each time you get better at it. Yeah, okay, I don't need, I've done my research. But I also think having GPs on as guests on podcasts, it's a great way, I think, for anybody to be able to vet whether somebody knows their subject matter. Because it's an hour, it's really not edited at all. So you can listen in and say, like, is this the vibe that I'm looking for? Is this the way that somebody's talking about their company and their investments? Is that something that's interesting to me? I think podcasts are a great way to be that first thing to get them less scared. Absolutely. And then they, like you said, then they can make that call to you. And then it's much, it's kind of demystified, because really, even though I grew up literally investing my whole life, I didn't know anything about syndications until I started the podcast. And then I started having all these guests, and I'm like, why, similar to what you said when you were a CPA, seeing all the flippers make, I was like, why aren't I investing passively? I'm like always annoyed when I'm active. So now I found it really fun.
Yeah. Now, if they've come up through what's become the normal investing framework in America, now Wall Street has called us alternative.
Yeah, right. Yeah.
It just blows my back. I'm sorry. Real estate's been around since the beginning of the world. Y'all are the Johnny come lately.
I grew up collecting rent cash in my hand as a teenager with my dad. That's I know what was first. Yeah.
Yeah, and likely your financial advisor doesn't know a lot about alternatives, or alts as they may call them.
Yeah.
Unless they're truly an independent RIA or something like that. So they can't explain to you the benefits of bonus depreciation and the tax advantages of owning real estate and things like that. I mean, it's the most tax advantaged investment in the world.
Yeah.
Some people would argue oil and gas, and I think oil and gas is great, but but you've been sort of inverse to the economy. You were loving it when it was 100, but today it's below 70.
Yeah. Yeah.
It's a little more volatile, but oil and gas can still be a great alternative investment with some good tax advantages. So.
Yeah, there's so many tax levers that you can pull. And I always say, of course, I'm sure you've told this a million times as a CPA, when people look at it, they almost think like you're telling them to cheat. It's like, no, it's the tax code. Yeah. It's there for a reason. Like, it's really a set of instructions on how you can save money. But as you were going back before talking about doctors, and it applies to a lot of busy professionals who also invest in real estate on the side, they're never maximizing their tax benefits because they don't have the time to understand. And they're just using, a regular accountant, which they do a great job, but they probably know a little bit about it, when it's not like they're not going to know the STR loophole or things like that. They're just, that's specialized.
Yeah. Yeah, who you surround yourself with matters, and it is very technical, and it's been put into the tax code for a reason.
Yeah, exactly.
Because we are a real estate-based economy. Sorry, Silicon Valley.
Yeah,
as long as we are physical beings, we're all going to exist in some piece of real estate.
Yeah,
and so and I own some tech. I'm not against tech, but just facts of the matter is, the world revolves around real estate. So.
We are incentivized to make deals and take the benefits. It's just about learning about them and understanding along the way. I mean, syndications are a great example of that, because you can get depreciation from a giant asset that goes into your taxes. That's the one thing I was really excited about. I was like, ooh, look at that. That's free, free depreciation right there. It's really nice.
Yeah, and absolutely, and I love the depreciation. But my other favorite is, I can hold this asset for 3 or 4 years. I can refinance it because I've improved the net operating income, which means I've increased the value. I can go borrow against that and take that cash tax-free.
Yeah.
And I'm not selling it. I'm going to keep operating, and you're still going to get some regular cash flow out of it. Yeah. It's going to be less, but you got a big chunk up front.
Yeah.
So, and You could technically do that with your stock portfolio, but usually you're going to be maxed out at a 50% loan to value. And by the way, the next stock market crash, your phone's going to ring and they're going to want you to true up your margin loan.
I used to run really high margin before they cared. And then now it's like when I call, I like say first, like, hey, what's the rate on the margin? It's always pretty good, like way better than the rates. Sure. And then they say something like that they never used to. They're like, oh, but we want you to be at like 25%. I'm like, what? Like, that's stupid. Yeah. I want more.
Out here telling me this stuff, but you don't believe in it either.
Yeah. Oh, we expect that margin call, which is not coming, but I appreciate that. Again, that's another metric that saves me from myself. Awesome, Stewart. Well, it's been an absolute pleasure. Is the best place for people to get information about you guys at, I think it's harvardgrace.com, right?
harvardgrace.com. You can find our resources there. You can give me your email address and shipping address. We'll send you a copy of the book if you want for free.
Yeah, right on the homepage. I see it there.
Yeah, and you can even find my Calendly link if you do want to just talk real estate. I'll talk with anybody about real estate most anytime. So grab the link and let's chat. So.
Awesome. Well, I really appreciate you spending the time. Great conversation.
Thank you.
All right. That was Stewart Heath. He's the founder and CEO of Harvard Grace Capital. Again, you can connect with him at harvardgrace.com. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of what's coming up on the next episode of Zen and the Art of Real Estate Investing. And it's a future casting episode. The future of this podcast in particular, because we're set to change things up a little bit as we move forward after 350 episodes and looking for more. You're going to hear all about it on the next episode. I'll see you there.